Everyone, and thank you for joining us. My name is Jeff Feinstein. I'm the managing partner at Pinnacle Partners. Pinnacle is a opportunity zone investment firm, and each and every day we're talking to individuals that have generated, monetized, realized a capital gain, and they're considering tax-efficient alternatives to defer, optimize their tax position, and begin to build a real estate portfolio. Increasingly, we've been seeing a number of small and medium-sized business sellers. Been fortunate through the markets in which they participate in. There might be a consolidation uh, led by private equity or other types of transactions. And in all those cases, the individuals, the partnerships are seeking advice and very specifically, that is to consider tax efficient ways to allocate and to gain direction, strategic guidance from a financial advisor. We've been partnered with Three Bell Capital now for over 2 years, a trusted partner and a very sophisticated approach to those that generate liquidity events and are actively building wealth. So today I'm really pleased to have Steve Stroud join me. Steve is a senior wealth advisor at Three Bell. Maybe Steve, say hello and give a brief introduction to Three Bell and yourself.
Thanks, Jeff. It's good to be here. Again, Steve Stroud with Three Bell Capital. Brief introduction on the firm. Three Bell is based out of the Bay Area, really in the heart of Silicon Valley. We've been around, we're founded really coming out of the ashes of the financial crisis. And kind of what we saw back then was that in order to create true portfolios, to protect and to continue to grow wealth for our clients, it required looking outside of the window of the traditional assets of stocks and bonds. Coming out of 2008, stocks down, bonds down, gold down, weren't a lot of good places to hide. And so our founders really set out to build something better. And so traditionally speaking, the majority of our clients are entrepreneurs of one way or another. And when we typically will work with them ahead of an exit or during an exit or even after an exit. But really what it comes down to is helping them to build and to transfer what had been a primary ownership and a concentrated position in ownership of their company into a lifelong portfolio. And it's something that was going to work with them and help them really to build that destination portfolio to provide for their families going forward.
Yeah, fantastic. And so, as I mentioned, we get inquiries routinely from more recently, it's been physicians of all types in the category seeking to sell their practice to a hospital consolidator, private equity consolidator. The FTC has been of some controversy, and I think tech M&A has been stifled, but that may change with the new administration. I think as we see the stock market rally of recently to market highs, maybe the IPO window reopens, and I do think M&A will be quite active for 25. There's certainly a lot of powder on the sidelines at a variety of asset managers. So, what would you suggest to a business owner who's seeking to sell? And by the way, that may be a portion of the business sold. We routinely speak to, owners that sell a GP stake, say 20-25% non-controlling position. But what are some of the considerations you'd suggest they evaluate before taking that step forward towards liquidity?
Yeah, I would say that it's never too early to start thinking about it. It's never too early to start planning. And frankly, it's never too late to start planning.
Mm-hmm.
We agree that we think, and I think that the market would agree to a certain extent, that the M&A activity is largely expected to open back up after several year period of at least rather dormant, or at least a sub trend type of trajectory that we've been on. The new administration brings in a lot of excitement. It also brings in a lot of unknowns. And the one thing that we would encourage people to do is to, really to set out and understand the landscape that's in front of you. Engage professionals, engage and kind of build your team around you as you move forward and as you begin these conversations. If things that have already been in motion, as I mentioned, I don't think it's ever too late to build that team around you. And so really the concluding factor is knowledge is power, and having a game plan well ahead of time to be able to execute really helps to alleviate both the stress and the complexity that's inherently involved with any consideration of an exit. And in doing so, bringing the confidence that you can actually try to enjoy that time period because it is an exciting period.
Mm-hmm. Yeah. And so, assuming success, uh, generally a big liquidity event, lump sum payment, um, the individual or partners are rewarded, and then they are staring at some sort of taxable gain. And so in our business, we're routinely speaking to these entrepreneurs seeking to shield a portion of that gain, look for some sort of tax efficient alternative, begin diversifying into real estate. And the Opportunity Zone legislation, which was enacted in 2017, Tax and Jobs Act, likely to be extended, is the most compelling tax shield ever enacted by Treasury. And certainly, we work with a number of entrepreneurs. They're taking a portion of that lump sum. They're doing the allocation you're describing, which may include some income generation and some other strategies I'd like you to opine on, but certainly beginning to build a core, uncorrelated real estate portfolio that's tax advantaged, and that's what opportunity zones represent. So, Steve, are there other considerations and other strategies you'd look to complement the QOZ investment?
There are. It really comes down to the first and foremost, just understanding what your tax outlook is going to look like. In many cases, incorporating a really an excellent tax and legal advisor along the way, making sure to evaluate any potential QSBS, which is qualified
Oh,
small business tax
right.
exemption. Um, Looking at creative and effective ways to first utilize everything that's kind of right in front of you. From there, we always encourage folks to not be in a rush whenever you're creating this type of destination portfolio. Oftentimes it can be something where we want to just kind of hang out and be patient in that capital deployment.
Mhm.
But within that, what we call our concentrated position or concentrated equity toolkit, there's a number of considerations. There is no silver bullet, there is no magic combination. But what it really comes down to is developing a deep and thorough understanding of what's important to you, what's important to the family, and ensuring that while taxes are a major consideration, looking at the ways that are available to you, looking at including the qualified opportunity zone type of investment as a potential inclusion in what that destination portfolio is going to look like. But it's a process that is worth spending some time on. It's worth engaging in type of a deep discovery type of approach. And it's something where, when done correctly, I know our clients are confident, and they are confident not only that they made the right decision, but confident in the future that lies ahead.
Very good. So let me offer a brief primer on the Opportunity Zone tax benefits. Um, and they are three very powerful tax benefits. So the first is deferral of the capital gains tax. So we've had this big liquidity event. Choose your number for simple math, 10 million, 5 million, and the associated tax, assuming it's long-term, most likely, 23.8% tax is deferred on that capital gain if it's invested in a QOZ, an Opportunity Zone investment, within 180 days the realization of the capital gain. That tax is deferred through April 15th of 2027. So that's like, as we like to consider that an interest-free loan from the IRS for that intervening period, and then the establishment of basis in the real estate investment equal to the pre-tax value of the gain. Thereafter, one can enjoy the use of depreciation, another powerful income, tax-efficient income solution during the holding period. And then, unlike the business where you exit, terminal sale, and there's a capital gain event, in the case of the opportunity zone, you qualify for tax exemption. So there's no capital gain associated with the appreciation of the underlying real estate. There's really no other vehicle available that provides tax exemption status after this holding period. So that's very powerful. Um, and Steve, you take those three benefits and you bucket them as time value money, say on the deferral. And so maybe what's your point of view in allocating into the QOZ for tax efficiency and real estate exposure?
Right. So QOZs are very powerful. Just as you mentioned, they're really unlike anything that we had seen prior to 2017. And there's a couple of components that we like to focus on. And the number one is that the tax deferral feature, being able to defer a capital gains tax payment on paper is good enough, right? You always want to pay no taxes before they're due.
Hmm.
However, when you look at the underlying math behind it, is what you can earn on that deferred tax payment during that time frame has a material impact. So just deferring taxes and sitting in cash is certainly feels good to not have that cash leave your grasp for the IRS.
Hmm.
However, what we find is that with appropriate and with attractive investment strategies, the potential to add on and to grow that capital during that time frame is a material impact to what the total, to what your net tax impact is actually going to be. From that point on, the full scope of benefits from the complete QOZ program simply means that from an income and from a cash flow planning standpoint, we know that within the end of the QOZ period, you effectively have another tax-free exit, which means another substantial bucket of capital that's going to be returned, to investors without a tax consequence. And so, and planning for, not only today and tomorrow, but for for the years ahead, we think that additional tax benefit, that tax exemption, is something that cannot be overlooked, and can oftentimes be utilized and be harnessed really to drive kind of that next step down the road.
Oh, indeed. Well, this has been really interesting and I think timely conversation as we head into year end. We have a new administration before us, and we're hopeful for growth in 25. I do agree with you. I think M&A transactions um, increase meaningfully. And then there are a number of unique strategies to take full advantage of that rewarding experience. So, Steve, if anyone in the audience wants to reach you, why don't you give us your contact details, please?
It's just very simple, Steve at 3-bell.com. Either myself or a member of my team is happy to just kind of sit down, even for an introductory conversation, and just to kind of lay out really how we think about this, what we think is important to consider as you're going through this next very exciting phase. It's something that our firm is uniquely positioned to help and assist with. And when we look, to give guidance, really a lot of what we're coming up with is not simply the math and efficiency of if this is the way to do it, but we listen to our clients, and oftentimes our guidance is based upon what clients said they wish they would have done years ago. So we would be happy to help continue and develop that conversation and reach out at any time.
Very good. And I can be reached at jeff@pinnacleoz.com. And so for anyone interested in learning about opportunity zone investing, and by the way, that program, we think we're very optimistic gets extended with the new administration. Certainly would enjoy a conversation. So thank you, Steve. I know this is one in a series of topics we'll discuss. I think we'll also discuss concentrated stock positions and strategies to monetize some gain and begin diversification. That'll be, I think, our next vignette or video. So thank you for your expertise, and thanks everyone for their time and attention. Have a great day.
Thanks, Jeff.